Last week we have decided that as soon as we meet for the class, we'll start with the case study on risk and uncertainty. So we'll take up the case now. We'll start with the case study. After that, we'll proceed with the other topics. So from the examination kit, we'll choose one question. We read through that. There's a case on so this is Sweet Cicely. The requirements are the use of pest analysis is one thing. Then it talks about based on this, what's the risk appetite of the investors, and then there's something again to do with what are the three new options for risk neutral investor would choose. Then the question still continues, and then it talks about I think only risk neutral investor would choose from the scenario. Let's take it up. I will also work out another case study on that, but we have to do pest analysis also. So let's take this question first. The content goes like this. Sweet Cicely manufactures sweets and confectionery and has delivered stable but modest increases to the shareholder wealth for many years. Following a change in ownership, the new shareholders are keen to increase the long-term performance of the business and are prepared to accept a high level of risk to achieve this. SC is considering setting up a factory to manufacture chocolate bars. There are three options, 1, 2, and 3 for the size and output capacity of the new chocolate factory. SC must choose a size most suited to the expected demand for its products. There are external factors as well as the impact of the quality, branding, and pricing of its products. Demand for SC chocolates will be influenced by external factors such as consumer taste for chocolate over other sweets and even the suggested health benefits of certain types of chocolate. A high cost ingredient in the chocolate bars is cocoa, a commodity traded on international markets. The market price of cocoa fluctuates with worldwide demand. Due to economic growth, chocolate consumption is rising in many countries where it was once considered a luxury. In some countries, however, governments are considering introducing additional taxes on products containing sugar in order to reduce the consumption of chocolate and confectionery products. Being derived from an agricultural crop, the availability and price of cocoa is also influenced by climatic conditions, soil erosion, and disease. Conflicts and political instability in cocoa growing regions can also restrict its availability. Recent technological advances in the production of cocoa, such as the use of genetically modified crops, promise higher yields from cocoa plants in the near future. You have been asked to help SC choose one of the three options for the new chocolate factory. One board member told you the board proposed expanding into cake manufacturing several years ago. With hindsight, our planning on that proposal was poor. We sold only slightly fewer cakes than expected, but hadn't realized how sensitive our operating profit would be to a small change in demand. The previous shareholders thought problems in the cake business would put their dividends at risk. So SC stopped manufacturing cakes barely a year after it started. The board does not want to repeat these mistakes. We want to minimize the opportunity cost of making the wrong decision about the size of the new chocolate factory. Appendix 1 shows the net present value for the three options discounted at SC's current cost of capital. Appendix 2 shows the expected operating profit generated by the three options. The questions are first, advise SC why decisions such as what size of chocolate factory to build must include considerations of risk and uncertainty, and evaluate the use of pest analysis in managing the risk and uncertainty surrounding the project. Second one talks about the risk appetite of the investor. So let's take this question to the Excel file, and then from there we will identify what are the points about each one, and then answer the question. Like we've done pest analysis, understood the explanation of pest analysis. P stands for political, E stands for economic, social, and technological. The extended format of EL, second E talks about environmental factors, and L talks about legal. But then if it is only given as pest, P and L are taken together. E will go with economic factors and the social factors. Okay. Um, Now we have to identify the political, economic, social, technological factors. Let's keep identifying what are the points here. It's a sweet and confectionery business and has delivered stable but modest increase to the shareholders' wealth for many years. Following a change in the ownership, the new shareholders are keen to increase the long-term performance. So the objective is now to establish the business well and do well in the long term, and are prepared to accept a high level of risk to achieve this. So the appetite of the new shareholders is clearly mentioned. So they have that appetite to take a risk. So they are risk seekers. So what's the reason why they want to take up high level of risk? What's the reason? You there? Anyone? If risk is high, what is the relationship with risk and return? How does return change? If risk is high, am I audible?
Returns are high.
Returns are also high. So why would they want to take a risk? Because they have a high expectation to earn high returns. So they want high profits to be earned. Now, SC is considering setting up a factory to manufacture chocolate bars. There are three options, 1, 2, and 3, for the size and output capacity of the new chocolate factory. So the chocolate factory they want to build, setting up a factory to manufacture chocolate bars. So which size of factory do they want to go ahead with? That is, the sizes are given as 1, 2, and 3. SC must choose a size more suited to the expected demand for its products. So the decision now The first decision here is about building a chocolate factory, but there is no standard size as such they would be taking up, but have to choose among one, size 2, and size 3 models. Then we are also given certain other details about the external factors, as well as the impact of the quality, branding, and pricing of its products. Demand for SC chocolate bars will be influenced by external factors such as, so to build the factory, so what factors are there? One second. Okay. See the external factors. Now, these external factors have to be considered. SC must choose a size most suited to the expected demand for its products. Now, as well as the impact of quality, branding, and pricing of its products. So these are internal decisions. See, pricing again, I mean, depends on external factors, how the competition is, etc. Quality aspects, it's an internal aspect. The demand for SC chocolate bars will be influenced by external factors such as consumer taste for chocolate over other sweets, and even the suggested health benefits of certain types of chocolate. A high cost ingredient in chocolate bars. A high cost ingredient in chocolate bars is cocoa, a commodity traded on international markets. The market price of cocoa fluctuates with worldwide demand. So one factor what we understand here is the raw material or the main ingredient which is used here in the manufacturing of chocolate bars is cocoa, and then this is a commodity traded on international market. So the price keeps fluctuating. The price of cocoa fluctuates with worldwide demand. So that's one important aspect what we have to look into. Due to economic, as the ingredient, as the raw material prices vary, the price of the main product, the finished goods also will vary. So that's one important thing. Due to economic growth, chocolate consumption is rising in many countries. So the demand for chocolate is increasing. Chocolate consumption is rising in many countries where it was once considered a luxury. In some countries, however, governments are considering introducing additional taxes. So there's another aspect we have to remember. See, governments are considering additional taxes on products containing sugar in order to reduce the consumption of chocolate and confectionery products. Being derived from an agricultural crop, the availability and price of cocoa is also influenced by climatic conditions. Climatic conditions, soil erosion, and disease. Conflicts and political instability in cocoa growing regions can also restrict its availability. Since it is a commodity traded on the international market, any kind of political instability in any of the countries or regions where cocoa is being produced, that will have an impact. So there is one more factor about the political instability in the regions where cocoa is grown. Recent technological advances in production of cocoa, such as the use of genetically modified crops, promise higher yields from cocoa plants in the near future. Okay, so there are many points given with respect to pest analysis. Identify what they are, place them under the respective category: political, economic, social, technological. So there are many things. So point by point, identify that, and then where to place them. Please understand that and then write that. So we will be taking up that exercise as well now. To proceed further, there are 3 options for new chocolate factory. You have been asked to help SC choose one choose one of the 3 problems for the new chocolate factory. One board member told you the board proposed expanding into cake manufacturing several years ago. So there's something about the size of the factory building. So the board proposed expanding into cake manufacturing several years ago. With hindsight, our planning on that proposal was poor. We sold only slightly fewer cakes than expected, but hadn't realized how sensitive our operating profit would be to a small change in demand. The previous shareholders thought problems in the cake business would put their dividends at risk. So SC stopped manufacturing cakes barely a year after it started. The board does not want to repeat these mistakes. We want to minimize the opportunity cost of making the wrong decision about the size of the new factory. Chocolate factory. So now it is connected to a previous scenario wherein they were able to sell only few cakes. Therefore, now they do not want to establish or set up a bigger factory premises or a smaller factory building. They want to go according to what the demand for the chocolates would be. Appendix 1 shows the net present value of the 3 options discounted at SC's current cost of capital. Appendix 2 shows the expected operating profit generated by the 3 options in the first year of the project, according to the market price of cocoa and assuming an annual demand of 70 million chocolate bars. So Appendix 1 has the net present value given for 3 options. The option 1, option 2, option 3. So, and if the annual demand for chocolate bars is 50 million, 60 million, 70 million. So, what's the net present value is already calculated. We have the details given to us. If the first size building is constructed, and if the annual demand is 50 million, it is 4, then it is 4 million, 6 million, then again 6 million for 70 million chocolates demand. Then option 2 has -8, 16, 16. Option 3 has -32, -24, and 17. Okay. Then we have Appendix 2. Appendix 2 says Expected operating profit generated by the three options in the first year of the project, assuming an annual demand of 70 million chocolate bars. If the probability is 0.3, 0.4, 0.3, and the market price of cocoa is 2,500, 3,000, 3,500. So there are three options of given for market price. There are three options for the factory building size. So when we look into that, the calculated operating profit for each of the scenarios is given to us. So we see 3.5 and minus 2, 5, 2 and minus 1, 7, 1.5 and minus 2. Let's start with the first one. So we are asked to take up a pest analysis. The first question talks about pest analysis. So as we identify what are the factors, let's place them and write it under the respective category. So we'll start with political. The first thing is political. As we identify, let's place it under the respective heading, political factors. Social factors. Then technological. Consumer taste for chocolates and other sweets, and even suggested the health benefits of certain types of chocolate. Where will it fall? The demand is influenced by these factors. One is consumer taste. Where will it go? Where do we see that?
Social factor, ma'am.
That's right. Because anything to do with the people is a social factor. So you just explain in the examination. I'm just writing in simple terms. You explain that clearly. Consumer taste for chocolates over other sweets. Consumer taste chocolates. Yes, sir. Yes. Next, we see, and even suggested health benefits of certain types of chocolate. So that is also about a high cost ingredient in chocolate bars is cocoa, a commodity traded on international markets. Since there are fluctuations in the worldwide demand, so the prices also will fluctuate. So where will we place this particular thing? The worldwide demand for cocoa. So if it is fluctuating, it's an economic factor. See, anything to do with exchange rate, inflation rate, interest rate, so these will have an impact on the economy, isn't it? So the fluctuation in the prices of cocoa, because they are traded on the international market, will have an impact on their um, foreign reserves also, because this product is being taken up by the um, people in the economy, so they are importing that product. So imports and exports definitely have an impact on the balance of payment, etc. So that will go with the one see, that aspect of fluctuation in the prices of the ingredient which is being imported will have an impact on the economy, economic factor. So that will be taken under economic factor. So the first the point under economic factor is price fluctuation of cocoa as it is. Next, after that, we see due to economic growth, chocolate consumption is rising in many countries where it was once considered a luxury. So the demand for the this particular product, chocolate or cocoa, is increasing. The demand is increasing. So when the demand increases, so the economic activity also gets affected, because when the demand increases, so the productive activity also will be connected to demand. So to produce those products, so there is an economic activity which goes on, so investment is made into that activity, that generates employment. Then see, we see that there is an impact on the income availability. Income increases, more income is available in the hands of people. This is all connected to an activity which takes place because of presence of because the demand is present for that particular product. So that increase in demand for a product, see, that is connected to the productivity. So productive activity will see an increase in the investment made into that activity, and that generates employment, that increases the income level. So income availability with the people also increases. So that has an overall impact on the economy. So that therefore it becomes an economic activity. So increase in demand for chocolate. There is an economic growth which is seen because the demand increases. So where when the aggregate demand increases, we see that growth happens. So how do we explain that? So I mean, you must be you must be knowing that see, the demand will give rise to the production. So because there is demand present, when the demand increases, the production increases. So this will result in Production increasing. So when the production increases, the activity starts to produce. So people will have work, employment increases. When employment opportunities are available, people will find work and their income also increases. Employment opportunities increase, and this will in turn increase the income that is available with people. So income increases, so more disposable income will be available with people. So then that will give rise to newer demand for newer products, because more income is available. Of course, the serious consequence of this is more disposable income is available, then that can in turn result in inflation. So that is the cycle which goes on. But as of now, because of demand, because of increase in demand, we see that economic growth is possible. And here in this particular scenario also, it is explained that um, due to economic growth, chocolate consumption is rising in many countries where it was once considered a luxury. So because now this is again a cycle. So the demand for products, now ultimately now it has resulted here because people have more income. So the additional income which is available in the hands of people has resulted in increase in demand for chocolate products, which was once considered as a luxury. See, we also see that if not it is about the chocolates, we see that there are many electrical products. We see that once what was considered as a luxury, now that has come into that category of comfort. See, people having a cell phone was a great luxury. People viewed them as someone belonging to elite group, but now we see that even a laborer worker also now owns a phone. And now the scenario is that they also have the smartphone now. So we see that that cycle of having more income in their hands has resulted in increase in demand for luxury products. Now that those luxury products now move into comfort zone. So this, because of the growth, because of the cycle which happens, because of more income available with the people, they are now able to have consume more amount of chocolates. So this is definitely a economic factor. In some countries, however, governments are considering introducing additional taxes. Now, any decision about tax, it is a political decision. Political, if there is a law relating to that, if there is a regulation relating to that, it is a legal aspect. Of course, now we are looking both the political and the legal aspects together. So any decision about the tax structure is a political factor. So why does the government want to do? So where it was however, governments are considering introducing additional taxes on products containing sugar in order to reduce the consumption of chocolate and confectionery products. So there is a decision from the government side that they want to reduce the consumption of chocolates. So the government also wants to reduce people to reduce the consumption of tobacco products, alcohol products. So consistently every year they keep increasing the taxes on that, but we don't see that there is so much of an impact on those products. See, even if the tax is increased also, as of now, so we see that the decision taken by the government is to increase taxes so that the consumption of chocolate products can decrease. So it is a political factor, increase in taxes. See, being derived from an agricultural crop, the availability and price of cocoa is also influenced by climatic conditions, soil erosion, and disease. So, what do we call these factors as? See, there are certain factors like climatic conditions, soil erosion, and diseases. These things also affect the supply, availability of this ingredient, cocoa, being derived from agricultural crop. The availability and prices of cocoa is also influenced. So where do we fit this into?
Environmental factors.
Environmental factors. So now if it was pestle under E, we would have written. Now where do we write? We can club them with E or S. So we can write it here as economic plus environment. Climatic conditions, soil erosion, and diseases. So these things affect the supply of cocoa. Conflicts and political instability in cocoa growing regions. So conflicts and political instability, we write it under political factors. Recent technological advances in the production of cocoa, such as the use of genetically modified crops. That's a technological factor. Anyway, it's given, and we understand that genetically modified crops can increase the yield, increase the crop. So that's a technological factor. Recent technological advances in the production of cocoa, such as the use of genetically modified crops, promise higher yields from cocoa plants in the near future. So, can be taken under technological factors. Okay, I don't write like this in the examination. When you have to explain, please explain that in detail. Now, after considering the pest analysis, how they would affect, I mean, what factors, what are the external factors, and how these factors affect the business and the activity. After we mentioned that, now we have to take up the next question. Now that's 14 marks. So we can see that 14 marks for 4 categories. So um, how many did we identify? 1, 2, 3, 4, 5, 6, 7, 8. 8 points we have identified. Maybe 1.5 marks or something like that would be allotted to each point. explain that in detail. So the overall presentation matters. Mostly write it in bullet points, so that it's easy to identify. If you write it in a paragraph form, the possibility of you repeating the points would be there. Here, if you write it, separate them as bullet points and then explain them. So point by point. So each point, whatever is are the marks that are allotted to that, say one mark or 1.5 mark. So whatever is the situation, so accordingly you will keep scoring marks. So then you will also understand that you should not be repeating the point, and then you've already covered a point. So you will not be repeating that. So don't go for a paragraph form of writing the answers. As far as possible, where you can fit bullet points, go for that and then do that. Clearly explain that, and then easy to score 14 marks. See, the content is already there in the case study itself. Just that you have to identify and categorize them, write it under, present it under the respective heading. That's it. The next question, which is for 6 marks, it says that using the data in Appendix 1, explain which of the 3 options for the new chocolate factory would be preferred by the board and the new shareholders according to the respective risk appetite. Risk appetite, see, risk seekers, risk averse um, investors, then we have risk neutral, then pessimist. So there are 4 categories of investors. So last week we have understood about what strategy they adopt. So we know that. So let's take it up. Let's put Appendix 1, and then I'll do the solution answer here, and then we can take it up. The question is, explain which of the 3 options for the chocolate factory would be preferred by the board and the new shareholders according to the respective risk appetite. Now here we see that new set of investors or shareholders have high appetite for taking up risk. So what is the strategy they would be adopting? So there are 4 things we see. Expected value is risk neutral. Someone who does not go with the brighter things, brighter side of a scenario. That is taken up by risk seekers, which is called as maximax risk seekers. They are okay. Their attitude is they are optimists. Maximum is by risk averse. They are not willing to take up any kind of risk. They are happy, content with the minimum amount of return. Only considering is that they don't risk their investment. So these are risk averse investors. So they don't they are not optimists. They fall under the category of pessimists, but not on such a severe note. Pessimist attitude is by is taken up by those that see the negative side of a scenario. So pessimist attitude, people choose minimax regret. They are also risk averse. They look at the regret which is associated with the um, alternatives not chosen. And base their decision on that. Okay, so now the new set of investors here, have high appetite for risk. So what should be the strategy? It would be maximax. What's maximax? See, there are we see there are three options and the three different annual demands for chocolate bars. Now each of them have the NPV calculated and given. We don't have to calculate the NPV. So if they choose option 1 or option 2 or option 3, so now which option? Options here relate to the size of the factory building, because they had not a pleasant experience with cake manufacturing business. So now they want to be cautious about that. So therefore, they don't want to go with a wrong decision. So if at all, if they have to choose the best option, so option 1, if they choose, say in situations where the annual demand is 50 million, 60 million, 70 million, we see that these are the values that are given, 4, 6 and 6. Then option 2 has -8, 16 and 16. And option 3 has -32, -24 and 17. So here in this case, we have to understand this is divided into two parts, maxi, max. Maxi, max, the second max talks about the returns. The returns which are associated, these are the returns. So if it is option 1, let's write the returns. Option 1, when we talk about the maximum returns, because the second part of it is maximum. Maximum returns are So once the maximum returns are mentioned, from among the maximum returns, the one which has uh, again maximum, the first part of it is again the first maximum. So maximum among the maximum returns. So this would be option 3. So this is highlighted here. Option 3, that is size of the building as 3, because they see the brighter picture, that is which is a maximum return of 17 can be earned, and they do not see, they are not a pessimist, they are optimists, they always see the bright things. So they have an expectation that if size 3 is selected, then in that case they would be able to maximize the return, and which is 17. So the investors would choose option 3 if the decision is about maximax. Let's say, anyway, because we have started, so let's also look into the, that's not asked, they are only asking about based on the appetite of the investors. Right now the appetite of the investors is maximum return, so maximax goes well with that. But if at all, if we have to do maximin, in that case, see, there are 3 options. So first they would be selecting the minimum returns. The second part of it is minimum. So wherever minimums are there, we go with that. So minimum return here would be 4. Then we see it is -8, and then we see 16 is the other one, and between that nobody would want to earn a minimum return which is in loss. So the next thing is 16. Okay, then comes option 3. Then again nobody would want to go with a loss, because the first 2 options have a loss. So here as well, now here in this situation as well, we see that the investors would go with the choice of option 3. The next part of it is based on appendix 1. The next thing what we can calculate is mini max regret. Mini max regret decision. So a regret table has to be prepared. So we need to now prepare a regret table. The regret table will have the same matrix format. We have option 1, option 2, option 3. Then the demand for the products is there as 50 million. So let's write this one. So demand is 50 million. $60 million. Then 70 million. How to prepare a regret table? So regret table will go like this. See, there are 3 situations where the demand is 50 million, 60 million, 70 million. In that case, so we have to now carefully choose. If it is the first situation, 50 million. So if it is 50 million scenario, what's the best thing that they can get? Let's say if the demand is 50 million, if they choose between option 1, option 2, and option 3, which one is the best one here? It is 4 is the best because the other two are negative. So if they choose option 1, will they have a regret? There would be no regret if they choose option 1 because that's the best thing. So regret here would be 0. Let's say take up a situation where the demand for chocolates is 50 million, and if they take up let's say if they have taken up the decision to build size 1 factory building, then size 1 factory building in a situation of 50 million annual demand for chocolates has a return or NPV as 4. But let's say if they go with option 2, build that, there is a negative NPV of -8, then third one has -32. So which one will be best in situation of 50 million? Option 1 is best. So if they have already taken a decision for option 1 and the demand is 50 million, and option 1 will leave them with no regret. But let's say they have taken a decision of going with option 2 and demand is 50 million. So what is their regret? Anyway, the loss is 4, and they also have foregone the benefit of earning 4. They have foregone with the benefit of earning 4. So anyway, 8 is the loss and the opportunity cost is 4. So here it would be -8. They are also foregoing -4. Okay, so that's their regret. Here in this case, it is -32, and they would have earned a benefit of 4, and now that is also foregone. So their total opportunity cost is -36. Come to the next scenario, 60 million. The 60 million, the best possible thing is with option 2. This is the best possible thing. 16 is the best. So if they choose 16, no regret. If they choose 16, regret would be 0. I mean, if they choose option 2, regret would be 0 because that's the best NPV. But let's say they have chosen option 1 and demand happens to be 60 million. They will be able to earn an NPV of for 6, where they had an opportunity to earn 16 by choosing 12. Now they have foregone 10. 10 is their opportunity cost. So here the opportunity cost is 10 for them. And third situation, in the third situation, we see 17 is the best thing. Now they want to, these are regrets. So maximum regrets, we see maximum regret with option 1 is -11, maximum regret with option 2 is 12, maximum regret with option 3 is 40. So identify what's the regret. Maximum regret is 11 here, maximum regret is 12 here, maximum regret is 40. So from the maximum regrets, choose the one which is minimum. So the minimum regret is with option 1. Mini-max regret rule, isn't it? If it is mini-max regret rule, then they would go with option 1. So the investors would choose option 1. I hope that's clear.
Yes, ma'am.
Then the next one, so that's only 6 months. So we can see that one important point you will consistently note down is wherever there are numerical calculations which are repetitive in nature, which is, the technique is not very difficult. Maybe the lengthwise it is big or small, doesn't matter. See, if there is not much of new content or new calculations included, even if it is time consuming, also there are not many marks allotted. Marks are allotted to analyze the scenario, identify that critical assessment is there, suggestions are there. In that case, more marks are given. The content may look very small and simple also. See, 14 marks are allotted to pest analysis. Technically, we see that pest analysis is very easy. Numerical calculations are difficult and time consuming. See, the weightage here is about not about um, um, the work which is data entry type of work, or work where it which involves a monotonous nature of work when it is done, that is not given important, but something where it has intellectual ability required to analyze the situation, more marks are given. So you need to understand what are those factors right then. You need to know how to analyze the situation, how to advise that, or critical assessment or explanation about that scenario, what benefits are associated with that particular aspect, etc. Like that, if the question is framed, more marks are allotted. So that one point is very, very important. Just because we've done, because generally we go with the assumption that see, wherever calculations are there, more marks can be scored, and they are scoring 6 marks for all the effort what we have put in until now. So 6 marks as compared to 14 is quite less, don't you think so? Then next one, the last bit is 5 marks. This one is about a risk neutral investor. So risk neutral investors, we have to depend on appendix 2, because risk neutral investor will go with expected value. Expected value is calculated as the returns into the probability value. So we have situations given. Option 1, first let's write the probability. There are 3 different probabilities. We see 0.3, then 0.4, then we have 0.3. Then option 1, let's have the NPVs given, because these are all no, these are operating profits given. We need to find out what is the expected operating profit. I'm just writing it as operating profit. The operating profit for option 1 is 3. Then we have it as 0.5. Then we have it as -2. The next one, it is 5, 2, and then -1. Then for option 3, we have it as 7, then 1.5, and then -2. Done. We just have to multiply these things. Expected profit is probability into the operating profit. Add it up. The sum total of it is. So expected value is 0.5 here. And for option 2, it is probability into the operating profit for each of these situations. So multiply that and then take it and add it up. So the weighted average value. Okay. So now based on expected values. So whichever has a highest value, which is option 3. So the if the investor is risk neutral, then option 3 will be selected because it has the highest expected value. So option 3 would be chosen. Okay, done. If time permits, at the end, we can take up another case study on risk and uncertainty. But as of now, we'll stop here. Okay, this is just to test how to take up a case study on where these techniques are used. Fine. I hope it's clear.